Gold has a reputation for being the ultimate safe haven asset, the one asset guaranteed to save you when the markets are in free fall. But there's only one problem. That's wrong. Because while gold can act as a safe haven asset in the opening days of almost every real crash, it doesn't rise, it falls. And we've seen this recently on those big red days for the market. Stocks dropping hard and gold, the thing that many people bought for specifically this moment, dropping 5% right alongside everything else. And people then conclude that gold is a scam and it doesn't even work when it's meant to. And they sell, right before the asset does what it was exactly supposed to do. But if you understand gold's true role, then you can avoid setting yourself up for exactly this mistake. So today, we break down the myth that gold must rise the instant markets crash, the counterintuitive reason it often falls first, and why the smartest money on earth is buying it while the ordinary investors panic sell. My name is Nick, and this is the Finance Bureau. Now, the consensus story goes something like this. A crash hits, everything else collapses, and gold shoots straight up because everyone flees to safety. And it's supposed to act as like a sort of insurance plan. The number for stocks goes down, and gold goes up. And this is a common belief in part because it's the idea sold by every gold advert and every doomer headline you've ever scrolled past. The issue, though, is that reality is a great deal messier. Because in the initial phase of a real market crash, gold typically falls too, and understanding why is the key to everything that follows. So, let's look at what actually happens in the first few days of a market panic. When a real crisis hits, the big institutional players, the hedge funds, the asset managers, they suddenly face margin calls and redemption requests. In other words, they owe cash, and they owe it right now. And to raise that cash, they have to sell something. But they don't sell the assets that have already collapsed because that's not really a good strategy. They sell what they can sell, the liquid in-profit positions with buyers still lined up. And gold, sitting on years of gains and trading in one of the deepest markets on the planet, is the first thing on the chopping block. Gold gets sold not despite its strength, but because of it. The very qualities that make gold valuable, its liquidity and embedded profit, are what make it the go-to source of emergency cash. Analysts have a phrase for this sort of dynamic, and they call it dash for cash. During an acute liquidity crunch, the correlation between almost every asset class converges towards 1, meaning everything gets sold indiscriminately just to raise dollars. And there's something else worth really understanding over here, guys. And that's that most of the gold being violently sold isn't physical bars inside a vault. It's what analysts call paper gold, futures and derivatives, often heavily leveraged. And when the margin calls hit, those leveraged positions get forced liquidated, and that forced selling drags the spot price down regardless of what physical demand actually looks like. A falling gold price in a panic simply reflects a systemic rush for liquidity. And the history proves it. Let's go back to March 2020. As COVID tore through the markets, gold didn't exactly act like the insurance everyone expected. It fell over 11%, dropping from $1,670 on February 24th to $1,486 by March 16th. And that's what those analysts call a dash for cash liquidation. And retail traders did exactly what you'd expect. They loudly declared gold was broken. But then, the Federal Reserve unleashed unlimited quantitative easing and slashed rates to zero. And sure enough, gold decoupled, ripping to new all-time highs above $2,060 an ounce by that August. The 11% crash and the surge to record highs happened within a few months. Now, let's wind back a bit more to the global financial crisis in 2008. Gold peaked around $1,000 an ounce in March. Then, as Lehman Brothers collapsed and panic gripped the system, it fell roughly 30% in a low near $700 by October. So anyone measuring gold by its crash price action alone would have called it a total failure. But Gold finished the entire year of 2008 up 2.8%, while the S&P 500 got smashed down around 37%. And from that October low, gold entered a monster bull run, climbing over 160% to an all-time peak of around $1,920 by 2011. So, that's the pattern. There might be a liquidity-driven drop first, but then the real move follows right after. And in that big move, fortunes are made. Now, that might sound easy, but there are market pullbacks all the time. How is an ordinary investor supposed to tell the difference between a healthy shakeout and a genuine collapse? Well, that's exactly what we built into the Finance Bureau newsletter. It's absolutely free, and we break down everything regarding global finance, commodity markets, macro trends, and monetary policy, so you never miss what truly matters in the markets. All you have to do is click the link in the description or scan this QR code on the left of your screen to get started. Right, back to bullion. Now, at this stage, it's worth asking, if gold falls in a crash, what is it actually for? Well, for starters, there's a difference between gold's nominal price and its purchasing power. You have to measure gold's performance over the full arc of the crisis, not just the initial crash. Think of it this way. Gold isn't really priced in dollars. It's actually that dollars are priced in gold. Since the world left the gold standard in 1971, gold has climbed from $35 an ounce to $4,000 today, while the US dollar has lost the vast majority of its purchasing power over that same period. Gold didn't get more valuable per se. The dollar got weaker, and gold simply held its ground. And that, my friends, is the real product that you're buying. You're kind of buying wealth insurance measured in decades. And that brings us to another very important point. Gold actually does two different things, and confusing them is where the real pain comes from. The first is what people call the volatility hedge, and that's the short-term flight to quality role, the one everyone expects gold to play when stocks tank. And, as we've just seen, in the first phase of a real crash, that hedge often fails, because the desperate need for cash overrides everything. And the second thing is the monetary hedge. This is the strategic long-term role, and it's the one that's really important. The monetary hedge defends against currency debasement, against reckless money printing, and the slow erosion of trust in the whole system. And that role dominates in the recovery phase, when central banks flood the world with new money and purchasing power starts leaking out of every currency. So let's consider all of this from the viewpoint of the everyday investor. They might have bought gold expecting the volatility hedge, instant protection on day one. Instead, they got the monetary hedge, which works on a completely different timeline. Gold did its job, but the investor ends up calling it a scam because they didn't ever draw that very important distinction. And in 2026, gold's all-important role as a monetary hedge has arguably never mattered more. Global debt has hit a record $353 trillion. And increasingly, both retail traders and institutions see gold as a system hedge, a politically neutral anchor against sovereign fiscal stress and the sheer weight of that debt. But we don't have to take this theory on faith, because in 2026, we got to watch this entire thesis play out at the scale of an entire nation. In comes Turkey. In early 2026, the escalation of the conflict between the US, Israel, and Iran sent global energy prices spiking. And Turkey was catastrophically exposed, importing nearly all of its natural gas and roughly 90% of its oil. Suddenly, it faced a dollar-denominated emergency, with inflation already running at over 30% and a policy interest rate of 37%. The lira was under siege, and the central bank had to defend it. And the sequence of what they reached for tells you everything. First, they burned through their foreign currency reserves, an estimated $26 billion in the opening weeks alone. Second, when that wasn't enough, Turkey also drew down its US Treasury holdings sharply during the same period. And only then, after those two lines of defense were exhausted, did they turn to gold. Turkey became the world's largest official gold seller in the first 5 months of 2026, offloading a net 81 tons. And the result was that many people pointed at this and said, see, even central banks are dumping their gold. It has failed. But they had it completely backwards. I mean, just think about the sequence I just mentioned. Gold wasn't the first thing that Turkey sold. It was the last. It was the final, most precious reserve they touched, tapped only when everything else was gone. And there's one more piece of crucial detail over here. The majority of those transactions weren't even permanent sales. They were gold for currency swaps, reversible arrangements to raise dollars temporarily while keeping a future claim on the metal. Only a fraction was sold outright. Turkey didn't abandon gold. It monetized it as the ultimate reserve of last resort. And the proof is in what came next. And the moment the ceasefire hit and energy prices eased, Turkey began rebuilding its gold position, unwinding a portion of those swaps. So essentially, Turkey only sold because gold was the one reserve still worth spending when the building was on fire. This is purchasing power preservation at the scale of a nation-state. But this is only one element of the story, because while Turkey was selling gold, the rest of the world's most powerful institutions were doing the exact opposite. In the same period that Turkey was selling, central banks around the world bought a net 244 tons of gold in the first quarter of 2026 alone. That's above the 5-year quarterly average, and it follows a trend. Over the last 4 years, central banks have averaged around 1,000 tons of gold purchases annually, roughly double the pace of the previous decade. The World Gold Council's 2026 survey of central banks found that 89% of reserve managers expect global gold holdings to keep rising over the next year. A record 45% plan to increase their own institution's gold holdings, the highest reading in the survey's history. And 74% expect the US dollar share of global reserves to be lower in 5 years. So, the people managing entire nations' wealth are betting against the dollar and pulling into gold. In fact, by mid-2026, gold overtook US treasuries to become the world's largest reserve asset for the first time since 1996, around 27% of global reserves versus 22% for treasuries. And who is driving this shift more than anyone else? China. As of June 2026, the People's Bank of China had bought gold for 20 consecutive months, adding nearly 15 tons in June alone, its biggest single-month haul since October 2023. Its total reserves now sit at 2,346 tons. But here's the crazy part. Gold still makes up only around 8.8% of China's total reserves, against a global average near 27%. That's a major difference, and with China ramping up their buys, it means that hundreds more tons of buying is likely to come as China closes the distance over the coming decade. But why is China doing this? Well, the answer takes us back to 2022, when Russia's foreign reserves were frozen in an instant by Western institutions. And that was a wake-up call for the whole world. Because, in contrast, gold held in your own vaults cannot be frozen, sanctioned, or weaponized by a foreign power. It's the one reserve asset with no counterparty and no off switch. For a nation that is eyeing a de-dollarized future, that is a deliberate strategy. And here's a fun little fact for you guys. China has also been moving to link its gold market development with its broader push for yuan internationalization. Now, the institutions that understand gold's real job aren't panicking out of it. Instead, they're accumulating into the weakness. The central banks of China, Poland, and others are buying into every dip, positioning for a world where the dollar's dominance fades and hard, neutral money reclaims the throne. They're looking to build the future of the global monetary system, one ton at a time. So I'm sure you guys can now see that there's a bit of a difference between how a nation views gold and how the average investor views gold. The average investor was told that gold was the ultimate hedge against the market going down, and then they watched it drop and concluded it was broken and dumped it, becoming the exit liquidity for the institutions who knew better. In June 2026, retail investors and gold ETFs saw outflows of $8.9 billion, even as central banks kept relentlessly buying. The people with the most information are accumulating through the fear, and the rest are selling into it right before the recovery. Gold is a volatility hedge that sometimes stumbles over shorter periods of time, but it's a monetary hedge that shines over the full arc of a crisis. Gold in 2026 is doing what it has always done since 1971, holding its ground while the currencies around it loses theirs. And the smart money is telling you, in tons rather than in words, exactly where they think this goes next. But what do you think? Are you accumulating alongside the Chinese central bank, betting that the monetary hedge is only getting started? Or do you think gold is over and we enter some kind of new era? Let me know your thoughts in the comments down below. And if you want to understand the bigger picture of how global debt and de-dollarization are reshaping the entire financial system, then you can check out our video on that right over here. And that's all from me today, guys. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, signing off.